You're listening to Real Talk Texas on 570 KLIF News and Information. Now, live in studio, your host, local real estate expert Steve Hakes.
Welcome to Real Talk Texas. I'm your host, Steve Hakes. Real Talk Texas is a forum where our listeners get real advice from real experts. And as always, you can reach out to me directly with any of your personal questions by jumping online and visiting us at realtalktexas.com. That's realtalktexas.com. Or you can simply call me when I'm off the air at 214-643-6021. That's 214-643-6021. And yes, I'm a federally licensed mortgage originator, NMLS license 242522. Well, guys, one of the things I really like to do is invite real experts onto the show that are in different industries that you might need help on as a listener out there. And what I mean by that is we've had tax professionals, we've had divorce professionals, we've had estate professionals. I, of course, am the mortgage professional. We've had some really great real estate agents on here to talk about the market as well. And one of the things that we're going to do today is we're going to talk in my wheelhouse, and that is in the mortgage industry and what's happening in the mortgage industry, some of the things you can do with the extremely low interest rates that you may not have thought of. And so you're going to want to stay tuned the whole show because we're going to get into some real specific things that may ring a bell for you. We're going to first talk about what's been happening in the mortgage industry. And as everyone knows, the mortgage guidelines have gotten tighter and tighter. And so what happened back when the mortgage meltdown happened was that the financial markets really lost their faith in the rating agencies. And what happened with Moody's and Standard & Poor's, they took a lot of heat for how they were rating these pools for the investors. And the way a money cycle works within mortgages is there's not just one guy there that has a bunch of mortgages, be it Fannie Mae or Freddie Mac or FHA or USDA or VA or a bank that really has all the money for mortgages. There's a real cycle that happens. What happens is when you go and you work with your mortgage professional, you come up with an interest rate and a mortgage note that's going to be executed at closing. What happens is that note is basically in place and nothing can change as far as your payment agreement with that mortgage professional. But if you've had a mortgage for very long, or like myself, I've had mortgages for almost 30 years. And what happens with that mortgage in a lot of cases is that mortgage servicing right is sold, or they'll tell you the note's been sold, and you'll get this notification that, well, your note was with affiliated bank, and now it's with Bank of America, or it's with Wells Fargo. And what they're doing is these companies are set up, they're not just a bank, they're set up with these huge mortgage servicing where they send out the bills and they collect the money for the ultimate holder of the note, or the one that's putting the money up for the note, be it Fannie Mae or VA or FHA or someone like that. What it is they're collecting those funds, and they get paid a really small amount of money for every mortgage loan that they do. But when they do, hundreds of thousands of those, then it becomes a profitable business for them. And that's why you see notes being sold based on the interest rate that your loan is, the term, and things like that, whatever's a favorable thing for them to make money on as they're servicing your notes. So that's how the money cycle works. So what happens is you do your loan with affiliated bank. They then sell off the right to service your loan. So let's just say we lent you a couple $100,000 for a mortgage. We use our money. We fund that loan at closing, a couple $100,000. Then we have a couple options. We can sell those off to a specific loan servicing company or bank on a one-by-one basis, or we can pull them together and sell them in blocks of loans. And that's why you'll see you may make your first couple payments to your mortgage company you did your loan with, and then all of a sudden it's been sold, and now you're paying someone else. And it's usually a large company that does that. because it's just very expensive to service loans as a small bank or a mortgage banker or something like that. So that's what's happening there. The other thing that you need to know about is that if you haven't had a mortgage since, let's just say the last time you did a mortgage was 2008 or 2007, that's when the meltdown happened, or prior to that, up to, let's go back to the year 2000. What happened in that time frame was you may have walked in and you've got excellent credit. And the loan professional could look at you and say, okay, you've got a great score. You've got 800 credit scores. Where do you work? How much do you make? How much money do you have in the bank? And they could actually do a loan based on your word that you made this amount, you're employed by there. They may call the employer and verify that you're employed, but they may not ask for bank statements, tax returns. They may not ask for W-2s. And your interest rate reflected that a little bit. You may have paid a quarter point higher, but the ease of getting the mortgage was pretty awesome back then. I mean, we used to say, if you could fog a mirror, you could get a loan, as long as you had good credit. So that's what happened prior to the mortgage meltdown. The bad part about that was that we in the industry call it the liar loans. I mean, you could make up whatever you wanted. As long as you felt comfortable with making the payment in that time in your life, you could get a loan. A lot of those loans went bad. People lost their jobs. Maybe they couldn't really afford what they thought they could afford, and they told their loan officer they made more than they did. All of those things happened during that time frame. So as a reaction to that, and part of the Dodd-Frank bill that came out, and that's really going to roll into place this year, a lot of what happened was the industry, or people like you and I, that maybe we were buying a Fannie Mae bond, and we were going to our stockbroker and we were saying, okay, I want to buy X amount of dollars in Fannie Mae bonds. They're rated at AAA or whatever. So we had a lot of confidence in those bonds when we were buying them. When the mortgage market started to melt down, people lost confidence. Moody and Standard & Poor's, the people that rate these pools of where the money comes from for mortgages, were being told, the public was being told that they didn't know what they were doing. So what happened was, they had to correct that situation. So all of the agencies, Fannie Mae, Freddie Mac, FHA, all of the banks got together and they started tightening the guidelines. So today when you go do a mortgage, you're going to bring in 2 years of your tax returns. We're going to prove everything. We're going to look at, it's very tight. You're going to look at all of what's in your bank account. And if there's any large deposits that are abnormal, they're going to make sure that we source that deposit to make sure that that money wasn't borrowed from someone else. And those are the things that you can expect when you're applying for a mortgage today. So today's show, if you just tuned in, we're listening to Real Talk Texas. And today we're going to talk about the mortgage money that's out there, how it got there, how we got to where we're at, some of the things you can do with these unbelievably low interest rates that are out there. It's just ridiculous. And we're going to talk about how those rates got there, how long I personally think they're going to stay there, and what you can do to better your financial picture out there. So stay tuned. We'll be back after the break to give you some real specifics.